Hello everyone, this is Glenn Downing, Certified Financial Planner Professional at Cameron Downing, a registered investment advisory firm here in Miami, Florida. This video is the first in a two-part series about retirement savings plans available to the small business. This one is about the Sep IRA, the next is the SIMPLE IRA. Now, traditionals and Roth IRAs are both individual retirement accounts. Here I'm talking about what you can do through your business to save for retirement, save on taxes, and retain employees. So let me launch in. The Simplified Employee Pension, or Sep IRA, is best used in a small shop with few or even no employees. It can be established by an individual proprietor, someone who files a Schedule C, or by a corporation, LLC, or partnership. Money goes into the SEP from employer contributions only. There's no opportunity for employee deferrals. There is an older version out there called a SAR-SEP, or Salary Reduction SEP, but these can't be opened since 1997, although there's plenty of them out there. There's no third-party administrator needed, meaning the SEP is easy to set up, and the only costs involved are associated with the underlying investment accounts. All contributions are tax-deductible to the employer. A SEP account is opened for each participant, and all funds contributed are immediately vested to the participant. The employer must cover employees who are age 21, have worked for the employer for any 3 out of the preceding 5 years, and worked more than 600 hours per year. Now, quick math, at 40 hours a week, that means 15 weeks. The contribution can be as much as 25% of each covered person's payroll, up to the maximum annual contribution allowed by the IRS of $57,000 in 2020. Sounds good so far, doesn't it? Well, it is, but here's the rub. Whatever percentage of payroll the employer contributes to his own account must also be contributed to all the participating employees' accounts. So say the owner has W-2 income from his own corporation of $100,000, and he pays 2 part-timers who each earn $20,000. The employer may contribute $25,000 to his SEP account, 25% of payroll, and then must also contribute $5,000 to each employee account. So you can see how the SEP is best for very small businesses, or perhaps businesses where all the employees are family. As a rule, the small employer, in establishing a qualified plan, wants to keep benefits paid to the employees to the minimum, just enough to attract and retain qualified employees. On the other hand, if all the employees are family members, contributing the same percentage across the board may be perfectly acceptable, if not desirable. Another feature of the SEP is that there is flexibility in contributions year to year. An employer may contribute the maximum one year or nothing at all in another year. The key point is that the contribution percentage of payroll must be consistent across all employee accounts. Now, let's look at the taxes. We've got some differences here between a corporate entity in which the business owner is a W-2 employee of his own corporation, and a flow-through entity, such as an LLC or a partnership. Here's a corporate scenario where there is no SEP contribution. Let's look at that first. W-2 income is $100,000. That's what's reported on the 1040. Taxpayers married filing jointly. Standard deduction is $24,800, so taxable income is $75,200. The federal tax is $8,449. A second scenario, the business owner makes a maximum 25% SEP contribution. In so doing, the taxable income on the 1040 is now $75,000, and after the standard deduction, taxable income is $50,200. The federal tax liability is now $56,29. This is a tax savings of $28,20. Another way to look at it is that it only costs $22,180 to make a $25,000 SEP contribution, and that's an immediate return of 11%. The contribution rules are more complex for the sole proprietor or the flow-through entity, because in this case, the maximum contribution is based on the business profit and not on payroll. The maximum contribution works out to be about 18.59% of net income for the owner rather than 25% of payroll. And this has to do with the fact that the SEP contribution itself is subtracted from the business gross income. There's some other retirement planning considerations in all of this. The self-employed person may very well be able to contribute the maximum to his SEP and also contribute to a traditional IRA or to a Roth IRA. The limits are separate. Above certain income limits, the traditional IRA may or may not be tax deductible. Often corporate business owners split their income between W-2 and dividend distributions in order to save on self-employment taxes. In the above discussion, the corporate business owner may want to pay himself, say, $50,000 in W-2 income and the other $50,000 as a dividend distribution. Several pros and cons here. Qualified dividends are taxed at long-term capital gains rates, which may be higher or lower than the owner's marginal rate. In 2020, a 12% marginal rate for married taxpayers extends up to $80,250 of AGI. So if you're in a 12% bracket, your dividends are taxed at a 0% rate. But cutting your W-2 income can also have the effect of reducing your Social Security benefits way down the road in later years. And a lower W-2 income for the corporate business owner means a lower potential SEP contribution, since the contribution is based as a percent of payroll and not dividend distributions. The second video in this two-part series is about the SIMPLE IRA, the Savings Incentive Match Plan for employees. This is another option for the small business owner, and a good one. So, have any questions for me? Well, feel free to get in touch. info@cameron-downing.com. Email me. Also, be sure to follow us on LinkedIn, Facebook, Instagram, and YouTube for more personal financial information that's relevant to you. Once again, this has been Glenn Downing, Certified Financial Planner Professional at Cameron Downing.